Let's talk about how to evaluate the risk and reward of small cap stocks, the advantage and the disadvantages of small cap stocks. Let's look at number one, analyzing financial health. Analyzing financial health. I want to look at the balance sheet strength. The balance sheet strength. So you examine the debt level. You look at the cash reserves, and you equally take into consideration liquidity ratio to ensure the company can manage its financial obligations. Can the company manage its financial obligations? Can it pay its debts, its short and long-term debt as at when due? So this could be gleaned from the outcome of analyzing the cash reserve and the debt level, as well as the liquidity ratio. You also take into consideration profitability. Profitability, it has to do with evaluating margins, earning growth, and return on equity to gauge operational efficiency and profits potential. Is the earning growing? How wide is the profit margin? What is the return on equity? So you take all these ratios into consideration to be able to analyze the company's financial health. Number two is evaluate market position and growth potential. You evaluate market potential, evaluating market potential and market position and growth potential. So we come to industry position. You assess the company's market share and competitive edge in its industry. What is known as the moat. What is the company's moat? Its competitive advantage compared to other companies in the sector or industries. You should be able to ascertain that. Not only that, you look at growth drivers. When we talk about growth drivers, you identify catalysts such as innovation, new product launches. You consider expansion, market expansion, and as well as other field of technology it could that could fuel growth. So you consider these areas. What are the growth drivers? Do they have new product that can fuel growth? Do they have an expanding market share? Or do they have technological advancement that could fuel growth? These are key growth drivers one should consider when it comes to evaluating, market position and growth potentials. Number three is volatility and liquidity risk. Volatility and liquidity risk. So in this case, you consider stock price volatility, and you look at how susceptible these companies are to price swings due to lower trading volumes and market sentiments. You monitor beta values for volatility insight. So beta here means the level of volatility displayed by the company in relation to the overall market. If the beta is 1, it means the company displays less volatility compared to the market. If the beta is more than 1, it indicates that the company displays a higher level of volatility compared to the overall market. So you consider price volatility and the beta. Number 2 here is the second concept here is liquidity. You check average daily trading volume to ensure ease of buying and selling shares without significant price impact. Can you very easily buy your shares? Can you very easily sell your shares without impacting the stock price significantly? So that's what liquidity is all about. The ease of buying and selling shares without impacting the company price, the stock price. Number 4 is management quality and corporate governance. Management quality and corporate governance. You look at the track records of members of the management team. In other words, leadership track records. You research kind of the experience and success history of key figures in the management team among the key executives. You trace their pedigree. You analyze their success with past companies they've managed. And not only that, you also highlight transparency. You look for companies with clear communication, regular earning reports, and solid corporate governance practices. These are what you consider. Do they report their earnings early, as expected? Do they report their earnings on time? And do they incorporate a high level of transparency in the earning reports? And also, do they have excellent corporate governance? You take this into consideration. Number 5 is valuation metrics. Please subscribe to this channel and like this video. Valuation metrics. So you analyze metrics like the PE ratios, as you compare industry peers to determine if the stock is overvalued or undervalued. You calculate the earning per share, that's the price of the company, the price of the stocks divided by the share outstanding, and then compare the figure you've gotten with what is obtainable with other companies in the same sector and see how cheap or how expensive the company is. Don't compare with companies outside the sector. That's a kind of apple to mango comparison, but apple to apple comparison within the same sector. You consider the price to sales as well as the price to book value ratio. So this is useful for assessing early stage companies with minimal earnings. These are emerging companies. They don't really have much by way of earnings, but you can still analyze them compared to cryptocurrency that you have no value for analysis, you have no basis for analysis. So you look at the price of the company stocks compared to the net asset value, the book value, and the figure will tell you precisely whether the company is cheap or not. If it is one, the company is cheap. If it's more than one, it is getting overvalued. Number 6 is a macroeconomics and sector risk. Macroeconomic and sector risk. So in this regards, you consider economic sensitivity. So small caps tend to be more sensitive to economic downturn and interest rate changes compared to larger cap companies. They are more sensitive to economic trends. And you equally examine sector trends. Consider how broader sector performance and regulatory changes could impact the company. How would the company be impacted by changes, be influenced by changes in a sector and by the overall regulatory changes by government regulations? Number 7 is diversification and time horizon. Diversification and time horizon. So in this case, you look into portfolio diversification. Okay, so you spread investment across sectors, across industries, across regions to mitigate that inherent volatility, you know, in mid-cap stocks. Not only that, you also highlight long-term commitment. Small cap investments often require longer time horizon to realize, potentials. To be able to realize potential rewards, you need to hold the stock for the long term. And so, by thoroughly analyzing these factors, our investors can make informed decisions about balancing high growth potential of small cap with their inherent risky nature.